All right, guys, how you doing? How you doing? How's everybody? Um, I know there's nobody there, but we're just gonna continue. Check out the top articles. We may not be live streamed that long today, but we're just gonna push it. All right, so uh, nothing huge is going on. Oh, first of all, let's check X. If we can hear if there's anything interesting going on, then we'll listen to that first. If not, we'll review some. All right, so there is nothing going on at X right now. We're gonna review a few articles. All right. The Dutch government has suspended on innovation at Nexpedia. I don't know what Nexpedia was, which allowed the government to block risk decisions at the Nijmegen-based chipmaker. Oh no! Oh no! Oh no! We break everything. We're breaking everything. Sorry, guys. The computer did all of that. Ms. Kermanson stated that in the light of the recent development, he has decided to suspend his order under the Goods Availability Act (GAA) regarding Expedia, allowing consultations with the European and international partners. He pointed out that he has had meetings with the Chinese authorities in the past few days and is satisfied with the steps they taken to ensure the supply of chips to Europe and the rest of the global market. Kermans also said that he views the measures that the Chinese are making as a sign of goodwill and promises the maintenance of constructive dialogue with the Chinese authorities in the coming weeks. He emphasized that Nexpedia has now continued with its operations without further government interruptions. The government concerns stemmed from actions taken by the new suspended CEO, which involves suspicious transfer of funds, private assets, and knowledge and technology to foreign entity. In a new development, Expedia has stated that it has also suspended the transfer of waivers to its subsidiaries in China following the local units alleged reversal to pay. The update adds the government crisis to Nexpedia. I think it's Nexpedia. Kermans denies government involvement in CEO decisions. Minister Vincent Kerman denies allegations that the Dutch government had allowed the CEO suspension. He explained that the individual members of Expedia itself initiated inquiry proceedings for the Enterprise Chamber of Amsterdam Court of Appeals. Kerman also asserted that the government has not decided nor is responsible for replacement of the shares under management. He added that this is a regular practice under the Dutch commercial law and the entity separate from the GAA order. The minister also mentioned that the Enterprise Chamber of the Amsterdam Court of Appeals, based on its independence assessment, has suspended one of the company's director under the Article of Association temporary non-executive director with decisive authority has been appointed for the duration of the inquiry proceedings. The company's shares except one, were also transferred to a trustee appointed by the division. This underscores the fact that in the courts of independent justice, there is significant reason doubt that proper governance and proper business conduct at the Nexpedia. So I don't know what the deal is, but hey, at least they can solve it. At least they can solve it. Christopher Hui, Hong Kong's Secretary for Finance Services, announced plans to expand crypto exemptions to digital assets and other categories, aiming for legislative approval in 2026. This move could increase the investment in cryptocurrencies like Bitcoin and Ethereum, enhancing Hong Kong's appeal as a fintech hub. Hong Kong's 2026 tax bill to target digital assets. Christopher Hui, Secretary for Financial Services and Treasury, outlined efforts to ensure Hong Kong's tax policies. These plans allow existing tax exemptions for families or offices and funds, aiming to cover private credit, carbon credits, and digital assets. The proposed bill will be presented to the Legislative Council in 2026. The expansion to digital assets is expected to attract significant institutional interest and enhance the capital flow into the Hong Kong's asset market. This change builds a previous exemption established in 2023. By incorporating digital assets under our tax exemption framework, we hope to stimulate capital inflows and attract institutional interest in the cryptocurrency market. Christopher Hui, Secretary of Finances, Treasury of Hong Kong. All right. The market's reaction indicates a potential increase in regional cryptocurrency activity. No immediate comments from global leaders were observed. However, Hong Kong's policies historically correlated with active exchange volume and indicator interest. Impact on cryptocurrencies, increased activity anticipation. Right, Ethereum or ETH could trade above $3,000 from CoinMarketCap. The market cap of $372 billion. Change indicators about close to 1.5% over the 24 hours, and it's 12.87% down over the past 7 days. All right. Malaysia crypto mine electricity theft costs $1.1 billion in 2020-2024. That's crazy. Why are they stealing it? Malaysia's national utility, Tenaga Nasional Berhad or TNB, reported losses exceeding 1.1 billion RM, 4.4 billion from illegal electricity theft tied to crypto mining. The theft occurred between 2020 and 2024. The Energy and Water Transformation Ministry disclosed the figures in a Parliament reply on November 19, 2025. Most cases involving Bitcoin mining rigs, but that bypass the meters to tap directly into the grid. So basically, they're stealing the electricity. Case search and detection methods, electricity theft causes linked to crypto mining increased 300% from 2018 to 2024. Detected incidents rose from 610 to 2018 to 2,397 in 2024. TNB recorded an average of 2,300 such thefts per year between 2020 and 2024. Criminal groups operate from rented warehouses, shops, or low traffic homes. They install heavy ventilation, air conditioners, and soundproofing to mask noise and heat. Operations shift the locations very few months to avoid detection. TNB received about 1,699 public complaints on crypto-related issues from January 2020 to 2024. Enforcement and raids, authorities identified 13,827 premises involved in theft. Joint operations by the TBN, Police and Malaysian Anti-Corruption Commission, Energy Commission, and the local council led to raids and seizures of thousands of mining rigs. In March 2025, Bukit Amin Criminal Investigation Department Director the Tuk Serimon reported that TNB lost about 529 million, about 121 million dollars that year, most from crypto mining. The Electricity Supply Act 1990 criminalizes matters tampering, with penalties up to 5 years in prison and fines. Crypto mining itself remains unregulated but requires a compliance with the general energy rules. All right. Technologies and regulatory responses. TNB installed smart meters at substations for real-time monitoring of electricity flow. These devices allow tempering or unusual spike in usage. The company built a database tracking owners and tenants at the suspected sites. TNB proposes AI proposes the AI predictive analysis to scan consumption patterns for anomalies. Losses of equal about 3% of TNB annual revenue and restrained. The National Grid Malaysia ranks in Bitcoin, ranks higher in Bitcoin hash rate, but lacks mining specific laws of traffic licensing or environmental standards. The Security Commission regulates digital asset trading but not mining operations. So that's interesting. It's interesting to see how companies, not companies, just governments are dealing with this issue right now. Man, the cold is getting me already. All right. Tap the screen for me, guys, if you're here. That's interesting. Malaysia is doing amazing with that rules. Let's see. BlackRock is selling. What they're selling yesterday when we seen the markets go crazy. I mean, they went up and then they came down so heavily. Mongol executed whatever that is. Okay, I can say some words today. Okay, transfer about 10,000 Bitcoin valued about $936 million to a new unmarked wallet address. They move acquired on Tuesday, ending an 8-month period of inactivity in major distributions. Blockchain data shows that the fund shifted from the exchange's cold storage to an address. No further movement from these destinations have appeared as of November 18th, 2025. So maybe they're gonna give some more wallets and deposit some more wallets. The Magog exchange collapsed in 2014 after hackers stole around 850,000, equivalent to billions at current prices. Trustees recovered about 200,000 Bitcoin over the following decades. Payments of credits started in mid 2024 but faced delays. Last month, the declines exceeded the to October extended to October 31st, 2026, to address procedural handles affecting thousands of claims. Remaining holders, post-transfer Magog retains about 34,689 Bitcoin in its wallets, with roughly $3 billion the prevalent rates. The stockpile reports ongoing distributions that the prior major outflows happened in March when 11,000 Bitcoin moved into an unknown entity valued around $1 billion. So let's see if they can stimulate market by depositing some extra Bitcoin to its owners. All right, what are you doing, Vitalik, the Ethereum guy? In a post on X, Solid Intel noted that the DevConnect and Ethereum develop event Buterin charged developers to transition a quantum-resistant cryptography within the next 3 years in order to stay secure. This has become necessary because of the rapid development with the quantum computing and the ability to crack systems. Notably, the elapsed curve cryptography is what secures several blockchains such as Ethereum, Bitcoin, and so on. If quantum computers can decrypt these blockchains, it can spell doom for the cryptocurrency industry. As Basalt Intel's claims, Buterin has warned that the ability to quantum computers to do this could happen before 2028 presidential elections in the U.S. This gives developers a very tight timeline of less than 4 years to build quantum-resistant computers. That's scary. Like a lot of institutions are building quantum computing, and that could destroy the market. Like, hey, they can crack any security, no matter how big it is, they can crack it. You know, the Ethereum co-founder believes that this is the only way for blockchains to stay secure, and with the rapid development of such computers, it implies that failure to transition to quantum-resistant cryptography could impose Ethereum to security risks. Primarily, cases of hacks could spike as perpetrators, whatever that word is, leverage quantum computers to compromise the Ethereum network and other blockchains. This might lead to a stealing of private keys to gain access to user funds, and that's crazy. especially majority of the cryptos are held in cold wallets. If they gain, I mean, I don't know. Is quantum computing going to attack the only the hot wallets, or they will also attack the cold wallets? That's where the question is. So if they can do both, then quantum computing could be a real risk for the market as a whole. These threats make Vitalik Buterin, whatever his name is, the Ethereum guy, warning very critical to ensure that the cryptocurrency industry stays ahead of possible threats from quantum evolution. Community members believe that Ethereum is in a good position to lead for other blockchains to develop in an energy efficient and quantum secure blockchain. Others in crypto space have also urged developers not to treat the threat lightly. The overall assumption is that the real time might be shorter than anticipated, hence the need of proper action. I mean, the thing is, we don't even know where the development of these computers are currently at. So if they saying, hey, let's build quantum resistant cryptographies that can resist the quantum computers, and you don't know how far the development of quantum computers are, then you're putting everybody at risk, because you're giving yourself a timeline of at least 4 years. But what if those computers already exist? You don't have time. You know what I mean? So not sure if that's gonna affect them, but I hope it doesn't. I mean, why don't they think about building those systems like before even quantum computing was a thing? Because once you're a developer, you're always thinking like you always have to think one step ahead. Hey, what could happen? Where could our threats be? CBS host Jim Cramer signals that he is fine with Bitcoin itself, but hints that the cabal is unnaturally keeping BTC above 90,000. I didn't feel the conspiracy chatter around the cryptocurrency. Popular commentators on financial markets, Jim Cramer finally spoke about Bitcoin today, which he had not done in a very long time, saying that he is fine. I cannot see. Goodness. Fine with the Bitcoin itself, but not with the mechanics around it. Pointing out how unusual BTC keeps sitting around 90,000 even when it looks weak. That's because people are holding and they don't want to sell it, idiot. What is he expecting when Satoshi Nakamoto holds over 1 million? All right, followed by BlackRock's holding 800 and around 820,000 Bitcoin, followed by Michael Saylor's strategy holding 640,000, followed by whoever else, could be U.S. government or one other one between U.S. government and Michael Saylor. But how is he expecting? I mean, this thing is only 21 million. And millions of other wallets hold some Bitcoin. Not adding the millions of Bitcoin that could have already get lost. Like, we don't even have too much. It's not even there. The Coinbase is holding their own. I mean, every exchange holds Bitcoin on their balance sheet that they own, separate from the customer funds. They hold the customer Bitcoin. They hold exchange. I mean, Grayscale is holding. So if you say top 20 ETFs and other institutions and individuals hold about 10 million Bitcoin, then you're only dealing with another 11 million. which 1 million to 2 million of that has, even 3 million, 4 million of that either got lost and the rest hasn't been minted yet. So what is he talking about? 90,000 is nothing for an asset like that. His post hit while Bitcoin traded around 91,500 after a dip of 89,800. That was immediately brought back. The setup fits almost perfectly in inverse Kramer playbook. For those not familiar, whenever Kramer calls out a stress or imbalance of a or imbalance, I cannot read tonight. Traders start watching the opposite directions. Today, price action supports that reaction. Almost feels like Cabal is trying to keep Bitcoin above 90,000. I like Bitcoin, but I do not like any of uh, derivatives created to play it or game it or mine it. Like you can't do anything if you don't mine Bitcoin. That's how it operates. You need miners. You know what I mean? That's how the system validates blocks. All right. BTC has been holding around 90,000 zone with the same pattern seen all month. Dips get observed faster, liquidity fills in instantly, and the chart never develops a proper downtrend move. Nothing about the rebound looked organic, it looks structural, and the market treats it that way. Bitcoin's cabal theory. It could be stressed out that Creamer's point was not about BTC long-term outlook. He focuses his focus was on the perhaps leverage structure, product and minor hedging that shape short-term price behavior. The instrument have boxed BTC into a 90,000, 92,000 area, but the CNBC host it looks like a cabal helping the cryptocurrency to keep it up. So whenever he fades, the market goes up. Whenever he says we're going up, the market does opposite. That's basically what they say. So in short, we need the quantum resistant transition to continue over the next 4 years. That's the goal. We also want to see the long-term holders or the whales of Bitcoin to build, and slowly, the trust in the market come back. Basically, I mean, all of those could help the price um, go up from 90,000. The Alpha Bank, which is developing a leading fintech company, won the Excellence in Fintech category at the prestigious Finovex Award in November 12th. This recognition highlights the bank's leadership in implementing innovations that not only involve advanced services to clients but also makes their businesses more efficient. In this article, we will explore three key areas where Alpha Bank demonstrates its leadership: the transition to cashless depositing, the development of artificial intelligence in fintech, and the creation of non-financial services. The transition of technology cash handling, online cash deposits as the future. The business services market is constantly evolving, and one of the latest trends is the shift from traditional cash collection to online payments. This trend is effective and convenient, and it increase the efficiency and security of the business. Alpha Bank offers its corporate clients on online cash deposit services that allows businesses to optimize financial processes to and reduce costs. The essence of this service is that cash is deposited into a corporate account without the involvement of collectors. Bank clients can do it using ADMs, automatic deposit machines, which can be installed directly into the premises in a store, restaurant, shopping center, or any other locations. And advantages of online cash deposit, according to the bank's expert, in the next 2 to 3 years, about 70% of companies will switch from traditional to online cash deposits. This is uh, this is confirmed by the fact that more than 70,000 retail outlets from Russia are already using Alpha Bank solutions for online cash deposits. New generations ADMs. Alpha Bank also was the first on the Russian market to launch the new generation of ADMs from Moneyron brand. These new devices enhance the transaction device security and can be adapted to specific businesses. Alpha Bank configures the software according to the company's requests. In the near future, ATMs will feature new options such as these innovations may make the processes of receiving and crediting cash events more convenient and reliable to for businesses. So how they gonna transfer the money from the premises or the businesses in the bank to the bank? I guess instead of keeping the cash, like whenever you deposit that money into the machine, the machine automatically credits your account while the money is still in there and not being collected. So the machine may be constant and then turns into deposits directly right away into your account, so you can use it without the money leaving at your premises. Hmm. In the modern world, artificial intelligence is becoming a key factor in the development of financial technologies. Alpha Bank actively integrates AI into the products and processes which implements customer services and enhance the business efficiency. AI in e-commerce. At the International Forum of Electronic Commercial and Retail Ecom and Retail Week, experts discussed the e-commerce market trends. Bank analysis noted that the e-commerce turnover in Russia will grow by an average of 25% per year in the coming years. By 2028, one of the three purchases in the country will be made online. One of the key trends in e-commerce is the integration of artificial intelligence. AI will also actively used by both buyers and sellers. On the one hand, buyers will receive personalized recommendations and assist that will help them choose products that complete purchases and complete. Okay, so basically they will shop for them and they will recommend the best items that they want. On the other hand, Sales will be able to automate business processes, speed up data responses, and create hyper personalized offer for clients. AI in big data analysis. Alpha Bank actively uses artificial intelligence for big data analysis. This allows the bank to offer clients non-financial services based on data analysis. Key areas of AI use in data work. Alpha Bank actively collaborates with partners to develop technologies. For example, the bank implement an end-to-end online order processes of automated deposit machines (ADM) services through API in collaborations with the organizations specialized in cash transportations. This allows for a reduction in manual labor, fast interactions between the bank and the partner, and increased transparency of operations. Creation of non-financial services. Anti-bank Alpha Bank is focused on creating non-financial services that help clients solve business problems and implement the customer experience. This is particularly important in conditions where clients expect banks not only to provide traditional financial products but also additional services that simplify their lives. Payments versus the SBP and self-service checkout. Previously, Alpha Bank and one of the federal groceries chain launched a payments via the system for the fast payment SPP and personal self checkouts. Now the customers can pay for goods without cash quickly and securely. The payment process is simple. Just scan the QR code on the screen and confirm the payment in the Alpha Bank mobile app. The solution The solution demonstrates the bank's commitment in developing safe and convenient services that allows clients to purchase without cash using only mobile technologies today. The new payment methods is available in more than 600 stores across the grocery chain where self-service kiosks are installed. That's impressive. That's impressive. I like it. I like a new development. What? The XRP chart printed the most chaotic moment of the week when the Kraken feed threw a vertical candle to 90,000 before snapping back to the $2.13 zone almost immediately as per TradingView. Just 1 second earlier, XRP just said $2.17, so the swing presented a more than 3,600 deviation on major US exchanges, which moves like this that do not occur under the normal market structures. Wow. So it moved crazy and then it came back. Who knows why it spiked? Maybe somebody was trying to become a trillionaire. All right. Let's see what X is talking about. If anybody, ooh, it's going on. I like to listen this. This one.
And for that nuclear part, they have already sent Saudi students to several countries around the world, including Argentina and Russia and Australia and the United States, South Korea, to be trained to run those power plants. So they are already ready in terms of human resources. Here is a part that is not publicized. The Trump administration made a deal with Saudis basically to focus on rare earth and critical minerals. As you know, Saudi Arabia is a very big land, and they have all kinds of minerals there. So there is a deal basically to extract these minerals. So of course there is a focus.
This keeps happening all the time, so pardon me, guys. I have to close this one, and then we'll start another one, and then I have to minimize it because
Solar farms and wind farms, they need those batteries.
all the X is good. It still runs on some issues and problems.
They avoid wasting power. That's what it is. So there is a deal to buy large number of batteries. We have not seen the details of that yet. I'll speak about the energy markets later on. Back to you.
Thank you, Anas. I have to tell you, I am really surprised about the market correction this early in the cycle. And when I say this early in the cycle, I don't mean necessarily in terms of the stock price growth, which frankly is impossible to analyze in a vacuum. We'll only be able to understand how outsized or how understated the stock growth of these companies has been, and generally the market, over the last, I don't know, let's call it 12 months, in hindsight. But we haven't yet seen any cracks. It's not like anything blew up. It's not like anyone reneged. It's not like anybody said, I have this money, but no way I have this money. I am incredibly surprised at the pullback in the face of, I'll let you go ahead. I mean, you're giving a lot of respect to this market, which I would not give that much respect and genius to this market, to all of a sudden realize that, oh, we've gone too far too fast. I mean, we're just getting announcements out of companies announcing that they're going to go ahead and build and use and produce, and all of a sudden the market is saying, no, this doesn't make sense. This is pie in the sky. There's no way we can achieve, the goals that have been set out. And by the way, it's not like this cycle has been going on for years and years. I mean, the big numbers that we've seen has only been over the last couple of months. It is, on the one hand, surprising. On the other hand, I'd say, for a person who is generally bullish long-term, reassuring. In the sense that, this is going to be a protracted, if this technology is right, and there's going to be a lot to do here, the bull run is going to go on for, quite some time. All right, Carlo, I'm going to give it over to you. I've got a lot to talk to you about, so let's get going.
So first, on the observation of AI, I think that people often do not see exponential trends in real time, and that is part of the reason why the market cannot wrap its head around what's about to happen with AI, because it's going to be on a trajectory that they can't fully absorb, and that's just my take. On the Pompliano thing, honestly, I got nothing on that. That was not on my radar. I did want to put on your radar, because I think it's relevant to market talk. Kraken raised $800 million at a $20 billion valuation, and there is speculation and rumors and reports from Bloomberg that they plan to IPO early 2026. We saw what happened with the Gemini IPO, and IPOs have been struggling of late. Shell's IPO is struggling. So I'm curious what the panel thinks about Kraken's IPO. And then briefly on stablecoins and private credit. I think that is why banks are starting to pivot to depository tokens as a way to capture deposits from big institutional players and then give them a bridge to stablecoins. I'll put something in the nest that I wrote this morning that kind of breaks down that use case, but I think that is banks' effort to retain deposits so they have liquidity for lending out, and giving stablecoins as an option to these entities so they can spend in stables, pays custody with banks on depository tokens.
Okay, let me go back for a sec to Pompliano. Not that I have any axe to grind with the guy, but let me just explain to the audience very generally what happened. Essentially, Anthony Pompliano, who was an early crypto guy, I'd say generally closer to the presidential administration, also involved, or was, I don't know if he's still involved, with Mark Yusko down in North Carolina and in the MetaPlanet deal and so on. He is launching a digital asset treasury company through a reverse merger, if I'm not mistaken. The whole rub about this was he's gonna put in a lot of his own cryptocurrency into this deal, and there was a very sweet, very sweet, overly sweet pay package for him that comes from this. The magnitude, I don't know, is in the few hundreds of millions of dollars. And the crypto space, I think, is generally, you know, some days the crypto space likes to be crazy and crypto bros and whatever, but, you know, some days, you know, it gets to its senses and says, look, this is way out of line. And there was a bunch of this is way out of line rhetoric when it came to this. You haven't seen any other digital asset treasury company formed with the same type of incentives or payday, you know, for the founder. And so there was a lot of rhetoric for a while that, you know, Anthony Pompliano is going to get ridiculously rich on this. Well, apparently a fund, I don't know it, called Glazer Capital has now bought a north of a 7% interest in the company that it's merging into, and has objected publicly to this arrangement and said it is not in the best interest of shareholders. And I think that it's good. It's good for governance because it brings, you know, something that is way out of bounds, you know, back into discussion to get into the boundaries. Otherwise, you know, there should be some discussion or a vote that may go ahead and turn the deal down. You know, on that point, I will try to weave a bunch of the stuff that I heard at yesterday's conference. Yesterday's conference was Axios. It's the BFD conference, the big whatever deal conference. The speakers were actually outstanding. You had the president of Coinbase, Emily Choi. You had co-founder of Blue Owl, Mark Lipschultz. You had, excellent, founder of Redbird Capital Partners, big sports private equity firm. And then the founder of Affirm, one of the BNPL guys. And then Jesse Cohen, who effectively is the head of Elliott Associates, which is a big activist hedge fund. My point in this, and then the founder of Polymarket, Shane Copen, who was off the charts, hilarious, funny, strange dude. Anyway, all these people are way smarter than I am. I mean, just brilliant people. Jesse Cohen at Elliott was talking about the demise of active investing, right? Over 60%, 60% of money in the market is in passive funds, passive index funds, or ETFs. That's incredible. For a market that was created to be democratic, that was the purpose, no one is exercising their right to vote in any independent manner. And that was just simply his point. And yes, I think there always will be opportunity, increasingly maybe opportunity for activist investors, especially as more and more capital becomes passive. That being said, since the majority of capital is passive and they do listen to the three large proxy firms that are out there, who go ahead and, you know, decide in some beautiful, objective way, you know, whether the proxy put up by the management team is good versus, let's say, someone outside the management team or outside the board goes ahead and puts up. I mean, essentially your life, your investing life as an activist investor is in the hands of those three proxy firms that go ahead and decide or opine on which they believe in an objective manner is a better proposal. And it just is important to recognize that the democracy that exists in markets is a real cornerstone. We've probably lost a bunch of it, and frankly, as investors, yes, it's like voting in your local election when you live in a heavily tilted one direction or another, place. Does my vote really matter at the end of the day? Yes, your vote matters. You should continue to go ahead and be active. And by the way, more importantly, the one question that was asked of Jesse Cohen that I thought was very important to be asked for people that haven't been in this position, there is no percentage of a company that you need to own in order to open your mouth, right? Either as an individual investor or as a fund. And that could be on a conference call or at a shareholder meeting or in a public letter. Like, you're allowed to do anything you want. The world could laugh at you, scoff at you. At the end of the day, what wins mostly in a lot of these situations, although there are sharp elbows, is the person who has the most reasonable points being made, who has the best argument. When, Jesse Cohen from Elliott was asked, what kind of percentage do you need to have before, you, Elliott, go ahead and say something? He's like, it doesn't matter. Sometimes we're the loudest when we own 1%, and sometimes we're the quietest when we own 10%. It all depends on, what it is that you're saying, how wrong management is, how right you are. And you should keep that in mind. Sorry to digress there, folks, but I thought it was important. To go back to, I wanted to go back to the Fannie Mae, Freddie Mac, Ackman presentation yesterday. I listened to it. Lumi, I know, listened to it as well. And I think it's important just to update the audience to the extent that there are any Fannie Mae, Freddie Mac investors, A, B, housing market watchers, as to what Ackman has said in terms of, I think, a shift in what we thought he was going to go ahead and say. So go ahead, Lumi.
Yeah, thank you again. And I wanted to point out, Ackman's space yesterday was a little glitchy, but he did confirm a few things which were very important. There was a live space, and then there's also a space of questions, where people on X could even ask a question. So I was lucky enough to ask a question. My question was on the merger of Fannie and Freddie, because there was a tweet by Trump where he did dollar MAGA and have the two companies merging as one. And I agreed with him before he even started that it was a bad idea. Because then you need Congress, you need everyone involved to merge these two companies. So he came out and made the most articulate argument, which we all retail, which we all speak in the back end, agree with this, which is to stay in conservatorship, but first get the government to recognize that the capital sweeps, which happened for almost like 13 years, is recognized by the government and marks down the preferred shares or some of the debt, which makes sense because Fannie and Freddie paid billions of dollars, hundreds of billions of dollars in cash sweeps. People might not know that. And then the cash sweeps ended a few years ago to allow the companies to recapitalize so that they could exit conservatorship. That's a whole scandal because the Obama administration, some people are going to really like this right now, the Obama administration used this as a cash cow to pay essentially for Obamacare and various other things. But what's also become apparent in the research is that there's 11,000 documents which have been basically classified by the Obama administration, which regard directly to Fannie and Freddie. And so this becomes a political thing. More and more people are realizing this, that, oh yeah, the Jeffrey Epstein files are interesting, but wait until you see these 11,000 redacted Obama documents, which most likely, potentially, in my opinion, have fraud in it. So fraud has no statute of limitation. Just want to point that out.
Lumi, can I jump in for a second and try to give a very, very short history of this for those that don't know anything about this? Okay, I think we've discussed this before. I'm going to try to make this really truncated. Essentially, during the Great Financial Crisis, these government-sponsored entities were going to go insolvent without some sort of rescue by the government. What the government did without following any process is it went ahead and injected money into these companies and effectively said to itself and to the world, without us, excuse me, sorry, without our capital, these companies would have gone bankrupt, and all of the stock and the preferred stock would have been worthless. And so therefore, because we rescued these companies, we, the government, are entitled from forevermore, we are entitled to all the excess free cash flow of these entities. Unfortunately, whatever side you're on, the government did not follow any sort of process. This was not legal, what they did. They essentially, yes, truth be told, they did rescue these companies, which would have failed without their rescue. On the other hand, they didn't follow a legal process. And without following the legal process, you can't just go ahead and extinguish existing folks, common stockholders, preferred shareholders, their property rights. And so the common shareholders and the preferred said, hey, this is great. After the great financial crisis is over, this is great, but you can't just go ahead and jump the line without a process here. You wouldn't do this in private markets. You certainly can't do this as the government. And so this litigation has gone on for a very long time. And the bottom line is that this certainly would be bad precedent in the United States if the shareholders were wiped out. That means during another financial crisis in the future, the government could come into anything, wipe all existing property rights out without any hearings, without any judiciary proceedings at all, and just simply say, thank you very much, we saved your asses, and just be happy that, you know, your losses weren't even worse than they were, which were to go to zero. And so,
David,
yeah.
Bill made that point. Bill made that point. So he said specifically, if the government doesn't adhere to the conservatorship rules which have been in place for almost 100 years, and we've seen many different companies exit conservatorship successfully, right? If they don't agree to the rules which are in place and they don't allow certain assets to basically have a bid again, then it means in the future, like you said, there will be no bid for these assets. And when you're trying to get something which is in conservatorship out of conservatorship, it will become impossible. So this is why Scott Bassett is a smart person. Bill said quite clearly that he spoke to this week the New York Stock Exchange, and they said that they would be delighted, quote, delighted, to have Fannie and Freddie back on the exchange. And it would only take a few weeks, right? Makes sense, right? Because everyone makes money.
Wait, let me just explain that point though. So what Admin is saying now is let's do this incrementally, which I think is the right approach, right? Because if you don't do this incrementally, it really is going to be a heavy lift. You're not going to be able to get this through Congress. And so what he's saying is, look, why don't we simply go ahead and convert the government's stake in Fannie and Freddie into equity? They'll have 80% of the equity. Let's call the debt paid off, which it has been. Let's be honest, it has been paid off, right? The government should not benefit from the free cash flow of these entities for forevermore. That's not fair. That's a robbery. Granted, it was a crazy point in time in the history of the world during the great financial crisis, but at the end of the day, the government is not there to enrich itself. The government is there to function for the purposes of the citizens, inclusive of the shareholders of Fannie and Freddie. So government, let's convert your stake into equity, and let's go ahead and get the stock trading again on the New York Stock Exchange, the stock that, because right now, it only trades over the counter, right? And so you go ahead, list the stock, put it on the NYSE. It'll give Trump what he loves, which is a stake in public companies. It'll give him a massive stake in these companies, and it will let the shareholders essentially free and now move these companies into a stage, clearly a clear stage, which it hasn't been. It's been operating under a cloud for so long. Let's put it into a clear place. We'll work on undoing the conservatorship as the next step in the process. He just wants to get liquidity. And I think this is a good thing for him. As a shareholder, he'll get 2 bites at the apple. He'll make appreciation on the stock price when it lists on the NYSE, and then eventually whenever the conservatorship gets wound down. I think the administration will like this because it's a simple move. It is not difficult. It's a question of whether, partisan politics gets involved in this, right? Whether there's
Well, they can't. So
No. Excuse me, I'm not talking about, in fact, a vote. I'm just talking about rhetoric. I'm sorry, Lumi. Yes, I agree with you. There is no requirement to go to Congress.
Oh yeah, the rhetoric is really crazy. So the rhetoric around property and mortgages, they're starting to turn things up. The 50-year mortgage idea, you could see that there was just certain groups who it was the worst thing in the world. But I said to them, I said, well, what happens to a family who are halfway paying their mortgage but need a little bit of space to breathe, right? The 50-year becomes a great idea. And grudgingly, they'll be like, yeah. But listen, Bill will be on today with Maria on Fox. I want to make a few other points. The US fintech company, which is made by both Fannie and Freddie, no one knows about it. People should look into that. That's going to be huge because that's a global software rights, I believe, one day for what they're going to be doing with Palantir, which is basically fraud detection, crime detection for mortgages, which would be a universal product. There's a few things which are really interesting, which Bill brought up as well. If by chance Fannie and Freddie get to any kind of market, or instead of an OTC, it becomes marginable for him, and that is huge for his portfolio. And you've got to think about all the other investors who are holding this as well for 17 years, who are mostly institutions. That's going to be a very important point for them. They want to have the ability to use this capital in various different ways and have flexibility. There's so many things to this, David. It's intense, but one thing I would say is watch for it. They were all signaling a time frame of next quarter, but there could be a Christmas present. So the foil is most likely an announcement around Christmas time, but the actual exit or the actual relisting, it's not an IPO, in the first quarter. So that's the hypothesis at the moment.
That's excellent. So for those in the audience that are all over the Trump trade, you may want to own some Fannie Mae, Freddie Mac stock. Freddie Mac is the more undervalued of the two on the basis of most metrics. I'll get to Paul in a second. Just breaking news. Dwayne, this one's for you, man. On another Trump trade, MP Materials, which has been unbelievable, extending their gains pre-market to 8% after announcing a JV with, drumroll please on us, Saudi Arabia. That's right. MP Materials is going to build a rare earth refinery in Saudi. The CEO of MP Materials is not a geologist or a mining expert. He is a financial dude. In the right place at the right time, friends. Just the, luck of the draw. I wish it by you guys as well. Just being in the right place. That's it. Everyone's going to beat a path to his door simply because he is the only U.S. play in rare earths. All right, Paul, your turn.
Yeah, on Freddie and Fannie, I think, there's a lot. I didn't listen to the whole presentation. I'm going to listen to today probably, but there's a lot of details that you really, I guess, got to get into, specifically by the companies no longer being, government guaranteed or government, implicit government guaranteed, definitely not guaranteed.
They will keep their guarantee. This was made clear. So this is a really important point because one way or another, they will always keep their guarantee. Bill actually went into detail about this. Sorry to interrupt you, but that's a really important point. Like JP Morgan has a guarantee, every single large American company has a guarantee, and especially Fannie and Freddie, it will never leave, and it won't affect the mortgage price as such.
Well, that's okay. I think that kind of gets into a little bit of a wrinkle. It's like, how can you have a private company or a public company, not owned by the government, owned 80% by the government, have a guarantee? Like, it's not a public company, really. It's not a private organization if it has a guarantee.
This is where it gets interesting. The details, 50%. So for what I know, you need the government or no single shareholder can own more than 50% of a company if it's going to relist from OTC onto NYC. So my point is that the government might actually take a haircut or have to do something interesting to meet the guidelines. So they said they were going to issue about dilute the common shareholders by 3 to 5% and sell some of their shares essentially and convert those warrants. But there might be a limit to what can happen because of just how they have to meet the guidelines. I don't know exactly. I'm not that kind of expert. Someone knows. Please tell me. but they might have to get a haircut, which would bring them in line to list, which would also nullify the argument you made about being massively owned by the government.
Yeah, I mean, the detail is when you actually look at the securities, let's say specified pools are actual pools. These aren't TBAs. So, there's a lot of details here, but let's say there's a list. There's a group of loans that back a specific specified pool, which is just a pass-through vehicle. Those are not rated, although you'll have like a Freddie Mac or Fannie Mae stamp, and it'll say, okay, FN 2351, blank, it's not a real security, but that's not the name of a security, but that's a security, and it doesn't have a rating, but it has an effective rating of AAA or whatever the sovereign rating is. Then those specified pools then back these things called CMOs. CMOs are then structured, into either different maturities, packs, companions, all these, you get into all this like early 80s structuring. Those also only have ratings because of the government guarantee. They're not SEC. They're actually not even SEC registered. Some of these, the way it works, but if you have a public, there's a lot of little details you kind of got to get into and just kind of say, well, where's the rating coming from? Now, if you actually pledge money or put a specific amount of money into a pot that comes from the government, through their sale to kind of maintain that rating, that could be, there's a lot of different techniques you could use. The main thing is that Freddie and Fannie are effectively insurance companies for mortgage pools. That's 100%. What they do.
That's get Buffett's biggest regret was not buying into this industry, because he understands this full well and understands there's a moat around this business, meaning that there's no other business that's going to just turn up tomorrow and be able to get government backing, have trillions of dollars on a balance sheet, and have hundreds of billions in capital. And so by definition, the government's not going to partner with any other entity because it already knows the deal it's going to get and what it's going to do. Bill Ackman actually suggested a small fee to be paid to the government for the privilege of having the government backing, which JP Morgan, all the other big banks do not do. Just to point that out, They don't pay a fee for the backing which they have received.
Well, so let me kind of step back quickly. So mortgages, you'll get a regular mortgage, whether it's 80%, 80% LTV or 100% LTV. That mortgage, typically what happens is it gets private insurance first, mortgage insurance, if it's over 80 LTV, from there's 7 or 8 different private insurance providers, mortgage insurance providers. Then Freddie or Fannie puts their wrap on top of that. So it's kind of almost like double insured. And then, Freddie and Fannie puts their stamp. It's used you could buy it as a specified pool. You could buy it as collateral for a CMO. Freddie and Fannie used to have corporate-backed bonds, corporate bonds with different maturities. Well, I don't know if they really still have that. And then Freddie and Fannie also insure commercial security, so bonds for multifamily, and so it's across this. It's not just residential; it's also multifamily property. So there's a lot of their hands are in a lot of different things. For Freddie and
most importantly, they don't do commercial. So this is all jumbo loans. There's not their thing. So it's generally
for this.
The government's going to bail them out. It's because they're family homes.
Yeah, but they still do, there's a Freddie Mac K program, they do multifamily, and that's the refi. That's how all any kind of multifamily owners, they'll build a property, they'll rent it up, and then they'll get a Freddie Mac K deal to refi down out of a high cost private loan.
Paul, can I just bring this back for a sec?
Yeah.
Okay. So look, I don't think Ackman is trying to work any of the hard issues out with this step. All he's trying to do, which he's good at, is create liquidity for his shares. Right? Right now, those shares are on the OTC. It is unclear what the legal status of those shares are. it is unclear what the government's legal state is with respect to these entities. He's saying, let's make that clear to the world first. Let's let the world know this is how much the government owns, this is how much the public owns. Let's put it on the NYSE, because until it's on the NYSE, there are loads and loads of funds that cannot invest in this, right? He's saying by putting it on the NYSE, it's a win for everybody, right? The shares all of a sudden are open to and probably need to be in a lot of portfolios of different types of investors, different types of ETFs, different types of closed-end vehicles, pension funds, whatever. So he's going to make a ton of money off of just that technicality. Then we get to eventually, hopefully eventually before the end of this presidential administration, working out the hard issues, which is, like you asked, what's the story with the guarantee? Is it implicit? Is it explicit? How does that work? What qualifies for this? How much does the government own? How much can the government own? When can the government sell its shares? All the harder stuff, kick that down the line. But for now, just create liquidity in the stock. That's all.
Yeah. David, the one thing I would say is there is a blueprint for this, and it's, I mean, a little bit different, but the privatization of Sallie Mae. Sallie Mae was a government sponsored org. It was a government chartered, had a government backing. It was GSE. It was privatized over 96 to 2004. 2004 was fully privatized, and now it's a public company or under a different name maybe now. But like there is a method to it. There's a lot of wrinkles with Freddie and Fannie, but I think to not be like, why is Sallie Mae able to be a fully private company and Freddie and Fannie not be? Like there's ways to do it, and the last thing I would say is the dividend. It was $310 billion that was the dividend sweep. So that was over the, 17 years. It was a massive amount of money. That was half of TARP. Like the TARP program, I remember, was like $600 billion. We used to think that was a lot of money back in 2008. Like it was half of TARP is what they recovered. So it wasn't a small number, and getting proper credit for that might be interesting to throw in there.
The other thing Bill mentioned, which I want to say, is that from his analysis, that Fannie and Freddie during the 2008 crisis, with the 0.45 capital ratio that they had, would have actually weathered it. Now, sounds crazy, but from his analysis, it was very clear that it was potentially they would have weathered the storm. So, one. And two, with the new calculations, the current capital ratios, they're asking for 4.5%, which is quite high. Like, that's significantly higher after 17 years. But what he's proposing is 2.5%, which is actually reasonable and would make sense. But this is the thing where it's kind of way above my pay grade. But that is still 5 times greater than what was happening in 2008. And also, we have new technology along with credit scores, which are much more accurate to mitigate risk and fraud and crime. So,
excellent, guys. Thank you for the discussion. Really helpful. Lumi, thanks for the summary. Anas, let's go, my friend. Nuclear power on 3 Mile Island. We've got nuclear reactors in Japan turning on after the Fukushima disaster, and then let's talk about everything oil and gas as well.
Sure, I will get to that. In the next, basically, you can see a chart that the global commercial oil inventories, they are rising significantly. That has been predicted, but the idea of record surplus basically does not make any sense. The increase in production and oil and water is ending up in storage. Let's remember that, yes, inventories are high and they are increasing, but global oil demand is at record high. Global oil production is at record high, so it comes with higher trade. And the question is, what is the ultimate level of storage needed to manage a market of this size? And that really should be the question, not the bearish sentiment that we see in the market. Oil prices declined today by about almost 3%. They are improving this a bit right now, but Brent prices remain in the 60s. They are not in the 40s and in the 30s as we've been told in recent months. Of course, now we realize with the decline in prices, many people realize that the Russian sanctions, the explosions, are all exaggerated because Russia is exporting normally. And today, Novak, who is the deputy prime minister, basically emphasized the point that Russia is exporting normally. Here is a joke for you. The sanction-obsessed media is celebrating a decision by a Chinese refiner who announced it will not import Russian oil. And it showed, that refiner showed evidence of buying oil from the UAE and other Gulf states as a replacement for, or they claim as a replacement for Russian oil. And the media got that without questioning it. Here's the problem. Again, I said this sounds like a joke, but it's real. That refiner has not imported any oil from Russia for 2 years. It's not importing, but they have a deal to make in the United States, the same refiner basically with a U.S. company, and they want to show that they are compliant. But they don't import Russian oil. There are also, the media reported that Russian Urals is sold in the 30s with a discount of almost $25 or $23. There is not a single evidence to support this news. ExxonMobil, this is, I think, is going to be a very big news. ExxonMobil is negotiating with the Iraqi government the acquisition of the Russian Luke oil assets in Korna 2 oil field. They produce 480,000 barrels a day. We don't know what's going to happen, but one thing that to do the negotiations directly with Luke oil, the Trump administration has to literally give an exemption from the sanctions to Luke oil so they can negotiate with Exxon. Back to nuclear. The reactor that's being shut down in 2019 and another unit being shut down in 1979. Now Constellation basically got a loan from the government. It's a $1 billion loan to revive the plant and literally make it active by 2027. This
Can they do it by 2027?
Yes, because the shutdown was mostly it's the end of the license, not the end of the plant. Because this is one of the issues with nuclear, that when they say we are giving you a license for 25 years, and people say, well, that's the end of it. No, that's the end of the license, not the end of the plant. No one knows exactly, even scientifically speaking, when is the end of the nuclear plant. We don't know. So when they give those licenses and then they assess the situation and they do extensions. So the answer is yes, they can. About the old unit, I don't know, the one that's been shut down in 1979. But for the unit they are working on now, or in the news, they can. But what the importance of this is, it seems that seriously, the government and the companies are extremely serious about AI and the energy demand of AI, because they realize that without it, we are going to have a crisis. And when we talk about crisis, think about it this way. The last thing that the companies want is a backlash from the public, because we are ending up with power shortages in the middle of the summer, and it's very hot, and they don't want them calling their senators and congressmen where the politicians will side with the people against those companies. So the main message out of this is that the government and the companies are really serious about meeting demand, whether they are using coal or nuclear or whatever weird sources you can imagine. They are very serious about it. And this brings us back to what I said earlier about the Saudis basically using nuclear, because that demand from AI is just massive in a way where probably we are even underestimating that demand. Back to you.
Excellent. Justin, over to you, sir. Some points about let's talk about autos, about Tesla. Also want to talk about Ford and Amazon. But first to you, sir.
Yeah, just a few brief notes yesterday that will be significant. Stellantis announced that they're adopting the NACS standard, and so this will take effect in North America, Japan, South Korea. For those that don't know, the NACS standard is the charging standard, North American charging standard, developed by Tesla. It's not. I do believe they released the patent years ago, so it's free for anybody to use. But this is bullish for Tesla because Stellantis cars will all be using Tesla supercharging on road trips, therefore, paying Tesla. So that's significant. That's a big win. Also, it was announced yesterday, Volvo will be discontinuing their relationship with Luminar Technologies, the LiDAR manufacturers. This was made famous by the Mark Rober experiment, where he partnered on a YouTube video that turned out to be not a quality video. And anyway, it's also bullish for Tesla because the Tesla engineering team has said for years now that LiDAR is a fool's errand and risky endeavor in vehicle, and that vision is the future. And so a lot of companies, I think, including Ford actually, that have said that they're going to work on their own technologies, they're going to use LiDARs and extra sensors. It turns out that people are retreating from that methodology and turning to vision. So this could be bullish for Tesla in licensing their full self-driving technology. So two major wins that will maybe materialize for Tesla this year or next.
Yeah, on Luminar, by the way, the company is probably going to go into bankruptcy.
Yeah, they warned their shareholders. It looks like it's not good. Hopefully,
I mean, Volvo is its biggest customer. I mean, this is what happens when you create a solution that only one party decides to use. I mean, sure, you have to start out with, a backer, a cheerleader, but you have to quickly move on to diversification. Otherwise, you're going to be in potentially a lot of trouble if all you can do is try to satisfy that one customer. So, yeah, we'll see what happens with Luminar, but it's likely headed out. Now, staying with autos for a second,
not to mention that their LiDAR technology was destroying people's cameras. I don't know if you
I didn't know that.
Yeah, the LiDAR, it shoots little concentrated, I don't exactly know how the technology works, but it basically spins in a circle and shoots high concentrated light beams everywhere, and apparently that damages certain camera sensors if they're close enough. So, like, people will have permanent streaking in their in the sensor on their cameras. So that's probably not good as well, because now that LiDAR is driving around with other cars that have cameras and like red light cameras and all this stuff, it's probably not good. So I'm not sure the effective distance. What I've heard is you have to be pretty close, but that may be another reason.
So sticking with autos, Ford is going to sell used vehicles on Amazon. This has been, a terribly difficult nut to crack. I wonder, I wish Lax was here to talk to us about the used auto retailers like CarMax and Carvana, if this is not necessarily good for them. In terms of Amazon taking away some business and potentially being maybe a better outlet. The other thing is, with respect to Amazon, Nikoski is not here any longer. All right. Anyway, 13F filings came out recently. A guy who we talk about every once in a while as being one of the best stock pickers around, David Tepper. Amazon is now his second largest position. Stan Druckenmiller, big position in Amazon. Soros, also, Amazon is his largest position. And you've got Bezos going back to work. I have to tell you, the tail of the news and the tail of the tape are two different tails right now. Incredibly. I believe so. I mean, listen, trust me, folks in the audience, my portfolio is suffering along with anybody else's who's been suffering, of late. I've been, down too. But there is nothing in the news that strikes me as we are headed for a brick wall, or even, a massive, fall off. I understand that the rate cut in December is the nearest, and here's Nikoski, is the nearest and most tangible, event that is going to come for us. But, it seems that there is liquidity. By the way, sticking on Amazon for a second, Amazon is raising debt for the first time since November 2022 in a 6-part bond sale. They are raising $12 billion. I mean, when Amazon goes out to raise money, since it is such a good borrower, it doesn't have to say anything about what it's going to use the money for. It's just general corporate purposes. But the assumption is that they're going to go ahead and use it for purposes of AI and data center, and the like. So are we going to run out of liquidity here in this country? If rates go lower, if Trump forces those rates lower, if he continues to go on his international, tour of nations and each time squeezes every leader to pump more money into the United States, yes, they may not have it immediately. They may have to go ahead and promise it and pay it out over time. But, I'm not concerned necessarily about a liquidity dry up here. And valuations have gotten away from us. Maybe, again, I'll only know that in retrospect. I can't know that today. It's very difficult. All we could say is valuations are at record highs based on current metrics. But if you go ahead and forecast out, and again, this is a speculative game, but if you try to go ahead and forecast out what those revenue earnings are going to be like once this entire, sector of AI data centers is up and running in full steam, then maybe those valuations are not, at runaway levels. Anyway, Dave Nikoski, over to you.
Yeah, a couple of things that I'm capturing, from yesterday's activity. High yield spreads are breaking out to 5-month highs right now, as of yesterday's activity. So I'm gonna, keep watching those. A lot of top formations in the financials. XLF, IAI, which is the broker index, is, to me, developing a major top. And I like to give things a 2 to 3 day rule. But if they break, they can also break very fast and tell me that I don't need to wait 2 to 3 days. So, the brokers are usually a good signal. The markets do not tend to go up when financials are breaking down. There's a very, very strong correlation there. It was interesting yesterday's tape that you actually had money coming into small caps, and IWM was up most of the day. The other side of the coin is, aside from some bearish, patterns that I'm seeing out there, we've been very bullish on biotech, and it would clearly seem to, and this diversion from the Russell 2000 is it's put in some at least large alligator jaws, if you know what I mean. Biotechs are far outperforming, and it looks like it's attracting capital from technology more than anything. As technology investors are questioning whether or not the AI move is going to continue, and they need growth-oriented names. So you have Amgen breaking out, you have J&J breaking out, you have Biogen making a bottom, you have Regeneron making a major bottom. So you do see at least some activity of capital rotation, something Northstar has talked about on the gold front, which I agree with. So, we have some great speakers in here, and if you listen to, the big picture on the macro side, I think it's very important that, what I'm seeing with biotech diverting from the Russell 2000 is something you don't enter a bear market and gravitate to biotechs for safety. I mean, the bigger ones are basically pharma companies, but even underneath, when you look at the names in the XBI, there's definitely capital rotation going in there. We've been bullish on them for several months, and they just absolutely continue to clock up into the right. You had the as I alluded to before, the amount of corrections that you're seeing underneath the surface for really crappy companies, be it quantum, be it nuclear, they continue to, trend down into the, right, which is not favorable. On the Bitcoin front, I do have a target of 75. I did take and buy some yesterday. I'm renting it. I am not a long-term holder until I see a more concrete chart that deciphers that it's a true reversal. Again, it's a rental to me. I'm happy to move out if things go further south. But again, high yield spreads are at 5-month highs. We've just taken out 3 previous highs in the last month when all of this activity in terms of the market showing some toppiness started. And I think that's important that if we see a high yield fallout, we have problems. You brought up Owl. I mean, that has got to be one of the ugliest charts I've seen. I mean, I wouldn't touch it. Affirm, I wouldn't go near it. Klarna became public. That thing is, ever since the IPO, going straight down. So I'm just, there's warning signs. There will be warning signs, and they're definitely present. The stocks index, I posted back on October 23rd. Its extension above the 200-day was at over 37%. That's the highest ever recorded. It's above the July 8th and 9th level, which I also call the top. Realized semiconductor, if you look at the stocks index, it didn't break out until August of this year to take out its previous high. That's from July 9th of last year to August of this year. For 1 year, they underperformed as a group. But the weightings in there are being so skewed that if you're throwing $100 into the stocks index, your weighting of NVIDIA just keeps going up and up and up. I would warn people about this passive investing that everyone seems to gravitate to based on studies that you buy the S&P and it continues to move up. There's a lot of really horrendous names in the S&P too, and I think that's where your active portfolio managers can really build alpha. I mean, if you look at the chemical stocks, the transport stocks, transports as a sector of the market is doing very well. Why? Because they added Lyft and Uber. Go take a look at, Werner Truck, WERN. Go look at, a number of these names are just straight down. They have been absolutely decimated, along with chemical companies, which continue to erode. Again, I'm going to say that there is a recession on the consumer side. All of this, again, is B2B spending, and that is what is holding this market up. If we get some if we close those alligator jaws, either we lift the crappy stuff, or we have a correction in the mega caps. That the S&P can stay in a bull market as long as Apple and Google continue to trend up into the right. If those break down like they did in February to April, you saw how that went. That was a 23% decline. So there's warnings out there in my book that I continue to emphasize since that October sell-off in nuclear, quantum, and the rare metals. It just, something doesn't add up. You are seeing capital rotation, and that would be my call right now. That's it for me. Back to you.
Cool. Thank you, Dave. We lost Unicus. Oh, Unicus is here. All right, let's do this. Brandon, are you here? Are you up on stage? You're going to join us?
Yeah, yes, sir. I'm up on stage.
Oh, you are? All right.
Yeah.
I can't see anything then. I'm flying blind. You're a listener on my phone. All right. So let's talk a little bit about private credit. Why don't we? Since I saw the co-founder of Blue Owl yesterday speak. Let's go ahead and flesh out a little bit, even though we have talked in the past about private credit, about private equity. Let's get Lax in on this discussion too. It's a really, look, we've seen some events over the past couple of weeks. They've been bloody and ugly, whether it be, frankly, First Brands and Tricolor we've spoken about. We've also spoken about, or I've mentioned, what's going on with, I forget the name of the telecom company. Guy also sold fake receivables, financing on fake receivables. Blackstone, I think, is tagged in that. And so the question is, are we at a breaking point for the two? And by the way, I know a lot of people like to go ahead and conflate private equity and private credit. I don't. I think it's two very different exercises. I understand it's both private money, private entities, but I believe very different. But in any event, let's get into this. First Lax, over to you, and then to Bert.
Hi, David. Thanks for having me. I have a connection problem. Can anybody hear me?
We can hear you.
Okay. So private credit, I think recently somebody called it as a garbage lending, and I 100% agree with that.
The two statements that have come out of luminaries recently were A, Jamie Dimon talking about cockroaches, and B, Jeff Gundlach, the bond king, yes, talking about garbage. So yes, go ahead.
With all due respect to Jamie Dimon, I don't think he can say anything about cockroaches because the recent article in Bloomberg, right, clearly said that I think JP Morgan is becoming very, very big, that Jamie doesn't know what's happening under his roof, so to speak. The Bloomberg article clearly says if Jamie Dimon has done his due diligence, they would not have taken a hit in Tricolor or First Brands or whatever it is, Tricolor, I believe, because Credit Suisse was the one first, started to give millions of dollars to Tricolor, and if they had done the due diligence, then they would know Daniel Chu had another firm co-founded, Trico or something, with a similar business model as Tricolor, and he got kicked out a year and a half later due to some accounting irregularities. If Credit Suisse has done its due diligence, then it would not have happened. And I think we covered this. So the latest news, I don't know if anybody heard, Tricolor had a creditor meeting today or yesterday, and Tricolor's management or anyone from Tricolor did not show up. They had the creditor meeting, all the creditors were on the line, and Tricolor did not show up. This continues to prove our point that, good luck with any creditor who's expecting any penny to be received from Tricolor or any kind of collateral. It's gone. And the same goes for First Brands. They are not going to find the $2 billion. It's just gone. And with respect to private credit is facing stress and potential losses. Some we know because it's been reported in the mainstream media, but most of it they are still, David, in my humble opinion, they are freaking out behind closed doors. I think it's a combination of multiple with a higher interest, and they are concerned about the credit quality of the loans that they have been lending, because some areas of lending are seeing high defaults. So the investors are freaking out, the creditors are freaking out. So the cockroach or not, this is not going to be the end of it. We are going to see more of private credit challenges in fourth quarter 2025 and well into 2026. Thank you, David.
Thank you. So I will say this on the other side of this argument, just to keep this balanced, right? So first of all, yes, I agree with you. Private credit has exploded over the past couple of years, and you can't continue. I mean, it's a volume game, and when your volume increases so fast to such great amounts, your quality of underwriting, it's hard to keep it the same. It's hard to keep it, strong. And certainly, if you've got, I think Blue Owl said they now have 10,000 loans outstanding. That's a big number. And But the majority of what they lend to are financial sponsors, right? They're not lending necessarily, or this is what they say, maybe they're lying. They don't lend to Daniel Chu. They're lending to KKR. They're lending to Bain. If you have a sponsor that's putting in, let's call it 45%, maybe 35% of the capital, and you're 55, 65%, right? The losses have to be greater than that equity piece before it even touches you. And if you're a private credit lender, you've probably written your documents so tight, your lending documents so tight. First of all, there's probably a ton of warranties and covenants that need to be complied with on a pretty frequent basis. Plus, you don't have to necessarily wait for quarterly financials. You could get financials according to your documentation, maybe monthly, maybe even weekly in the cases of some loans. And so the construct of private credit versus other loans, and certainly maybe high yield bonds, and this goes back to Nikoski, the construct makes private credit potentially safer. I'm not saying that it is on the whole, right? It all depends on the other underwriting, who you're lending to, what kind of stuff you're chasing, and so on. And granted, money is more expensive potentially than public market money. So maybe you're attracting the crap of the crap that can't bother to go ahead and borrow on the public markets, right?
You in that side?
But that being said,
oh my goodness,
private credit should be a better construct. All right, Brandon, over to you.
Yeah, I'm going to try to tie some of this in together because it's really interesting to me. And again, this is where I mostly operate is in private markets. I saw a post from Jason Lemkin just yesterday, who he runs SaaStr, great VC, has made a ton of great investments. And he talked about 2025 IPOs. I'm just going to read this word for word, bar for bar here. What happened in 2025 IPOs if you bought near the peak? And he goes down the list. Figma.
Where was
down
he at?
74%. Circle